Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again David Jensen. Welcome, David.
Good morning, Jay.
Really good to talk to you again. We've talked almost every week about the GOFO rate on this show, but just to make sure we understand what we're talking about, David, I sort of had the idea that the GOFO rate was pretty much in tandem with the backwardation of gold when we talk about the GOFO rate. But talk to us, explain to us what you mean by the GOFO rate and exactly what is it?
Yeah, it is related to backwardation. When you have backwardation being defined as when your spot price is actually higher than any of your futures prices, and typically the standard way of looking at that is that those prices should not have that relationship, that your spot price should be lower than a futures price because of the cost. Typically people explain it as the cost of storing and insuring gold, and as a consequence your futures price should be higher. So and that should always be extinguished immediately as soon as it's offered also, because if you can sell gold in the futures market at a higher price, in the spot market at a higher price, and then buy a futures position, you have guaranteed profit notionally. Right? So anytime that you have a price situation where the physical material, you have it in hand, and you can get a higher price now in the market for gold and silver, that should lead to selling and extinguishment of that correlation. Now, GOFO is a comparison of the lease rate of gold versus the LIBOR interest rate. So the lease rate, you can look at the interest rate for leasing gold and the cost of leasing gold, and then LIBOR is the cost of borrowing U.S. dollars. And so a negative GOFO equals, in definition, LIBOR minus the gold lease rate. So LIBOR is an interest paid on U.S. dollars, and the gold lease is what it is. So when that goes negative, that your gold lease rate is higher than your U.S. dollar rate, then you have a negative number, and that is the anomaly. And the fact that we're fluttering around zero, that those numbers are approximately the same. This morning, it's about 0.1%. For the 1 month, 2 month, and the 3 month rate of gold leasing. So, as last week, it's for all intents and purposes roughly the same cost. So it's it's not negative, but it's very close to zero. And then in historical terms, that has averaged between 2 and let's say 6% for more than a decade. And with an average of about 4% in there, and we're at about 0.1%. So that gives us an idea of how out of whack the gold markets are and the interest rate markets are.
Yeah, so let me understand. Gold is very cheap to borrow now, relatively cheap to borrow than it has been historically the case.
Well, it really it's the relationship between borrowing gold and then borrowing dollars. That's what we're looking at, and the fact that they are, that gold has been more expensive to borrow than U.S. dollars has been the anomaly.
Yes.
That has not been the case in the past.
Yeah, so it's a relative cost of borrowing U.S. dollars versus gold.
Yes.
And that's sort of, and we see a spike, I think, back in 2008, 2009, leading up almost to the crisis. Do you put that together?
Yeah, it was just there was a shortage of gold, and maybe there were positions being unwound, but I submit that probably people were piling into gold for security as well. And as a consequence, there was a physical gold shortage, which manifested itself through the spiking lease rates.
Yeah, so it got very expensive to borrow gold then at that point in time. Yeah. All right, well, we're seeing much more pronounced anomalies in platinum and palladium markets. You and I have talked about this recently, and your feeling is that this could be a precursor to similar anomalies of a greater magnitude in silver and then later in gold. What's the situation now with the platinum and palladium markets?
Today, I did a check this morning, and this is Monday, the 14th of July, and the palladium premium in Shanghai was about $137 an ounce.
Wow.
and it continues from last week. And the platinum premium was about $93 an ounce on the Shanghai Metals Exchange, and about $64 an ounce on the Shanghai Gold Exchange. So between the two of them, they're averaging about $70 an ounce. So we can see those two platinum group metals, platinum and palladium, that they're both trading at substantial premia to London and New York, which are, those markets are primarily derivatives markets. They're digital trading markets. And as you and I were joking about before the show, this is kind of the hangnail that you can't ignore. Yeah. In terms of the metals markets. It's just standing out. Mm-hmm. And the fact that it's not extinguished, and then also, I've talked about this trading pattern in the palladium price pattern being very similar to a period in the past, and maybe we can touch upon that later on.
Sure. Well, so what it means then, I mean, if I'm a mining company and I have platinum or palladium to sell, and I could get $93 or $64 for platinum and $137 more from palladium, why wouldn't I sell directly to those physical markets in Shanghai or wherever?
Well, you should, or you should at least be using their benchmark prices, because they are reflective of the price of the physical metal. And what we're doing is typically when we see mining companies, including my own in the past, we were doing our delivery contracts priced on the LBMA, London Bullion Market Association, for gold, and the LPPM, which is the platinum and palladium market in London. And, those are really digital derivatives benchmarks. And the mining companies have to wake up to the fact that the price is being set by derivatives trading, and that if you're dealing in physical, that you would be wanting to price your physical on a physical market. And so what I think we're seeing, and that we've mentioned this on previous discussions between you and I and your show, Jay, is that I think we're starting to see a parting of the ways between the physical markets and the derivatives markets. Mm-hmm. And I think it's showing there, particularly on the palladium and platinum markets, because of the duress those markets have been under in terms of the shutdown of the
South Africa.
Yeah, the South African mining companies. As well as, the second component has been that the Russian State Metals Agency has announced that it's going to be entering the palladium market and buying physical palladium. They're 40% of the world's source, and there was a crisis in the late 90s, and that was addressed by the Russians dumping their palladium into the market to contain the price, to smother the price. This time, they're doing the exact opposite. So, and we're seeing it now in the physical price on real physical markets, which we're seeing in China.
Why do you think the Russians are doing this all of a sudden? Do you think they're seeing a massive global shortage of platinum and palladium going forward for a while?
Yeah, and perhaps they can restructure the market pricing mechanism so it becomes more of a physical pricing mechanism as opposed to a digital one. And the other thing too is that the sanctions which were applied to Russia, mm-hmm. I mean, Putin responded and said we will respond, but sanctions aren't our way. Mm-hmm. And it could be that with speculation, but it came at about the same time. So, mm-hmm. And certainly in the 90s, in 96 and 97, there was a real crisis in that market. And a number of the European banks, including Dresdner Bank, almost went under because of their trading positions, that they were unable to deliver physical on their short positions.
Mm-hmm. Well, it's certainly interesting to speculate about these geopolitical relationships, but certainly with Russia and China seemingly becoming closer with respect to trade, and China having an urgent need for platinum and palladium, and given their environmental issues and the automobile production that's going on. Yes. There, that you would think that Putin may be looking longer term at that global shortage. It certainly seems to me that if I were a young and aggressive treasurer of one of these platinum and palladium companies, I would be looking to earn some points with my boss by getting $93 or $137 more per ounce of production. And so I would wonder if there's if that is starting to happen, and if not, if there might be some political roadblocks that are put in the way, trade roadblocks, etc., that the establishment here may want to thwart that free market option. I don't know. That's just a thought. Any ideas about that?
Well, I think that the mining companies are they have a fiduciary responsibility to their shareholders, and it's in the best interests of the corporation to maximize their profits. So at some point, the markets, these mining companies, pardon me, are going to figure that out, and I think what we'll see is that the markets, which are the physical markets, we're going to see a kind of a spread of this physical metal shortage to the other markets, and it'll become very obvious, I think. China in particular, I mean, they've got no palladium production to speak of, and they're selling over 12 million cars a year in that market, and it's a very, very busy market. And as you noted, they have a real pollution problem.
Yeah.
So I mean, this price differential appears to be driven by real supply-demand fundamentals. And the fact that it's existed and not being met means that there's a problem with the market pricing structure.
Well, it sure does seem as though markets should even out, and those sort of arbitrage opportunities, when they're available, should almost instantly be taken care of. But we've been talking about this for a little while now, and I don't know. Maybe the mining companies just aren't awake. Whatever. Let's move on to another topic. When we hear the term allocated and unallocated metals that are stored in various exchanges and places, trading allocated or unallocated, explain to us why it's sort of a misnomer. Unallocated is a misnomer.
Yeah, I mean, China, the Shanghai Gold Exchange, they trade only allocated gold, and that's a term that means that there's actually a bar there for a trading position. Mm-hmm. So for each ounce that you sell on a contract basis into that market has to have a bar deposited in a vault in China. Mm-hmm. So there's none of this, what we call paper gold, or is also called unallocated gold. But it's, unallocated, a better term for, in my mind, or to my interpretation, is non-existent. The gold is not there to back that position. And, unallocated is kind of it's kind of a feel-good term. It's not really dealing with the issue. And I mean, the Reserve Bank of India estimated that the ratio of gold to these unallocated trading positions was about 92 to 1. Mm-hmm. And, it's the number is as an industry benchmark is about 100 to 1. And so that if you're trading these positions and, trading hundreds of millions of ounces of gold a day, that the vast, vast majority of that is just, digital instruments, and it's non-existent. It's not unallocated. It's just not there. It's not in the vault.
Well, the unallocated is sort of a spin term, it seems to me, because it's implying that it is there. It's just that you don't have your name on it, or it doesn't have a number that is yours. So yeah, to me, it's a sort of a propaganda instrument, almost as a way of making people, as you say, it's a feel-good terminology.
Well, the LBMA says that part of the reason for the gold not being allocated is that it's forward sold by mining companies, mm-hmm. and as a consequence, it's to be delivered in the future. Mm-hmm. And let's just look at that. If you are just going to deliver it in the future, that's fine. But that gold core paper, we keep coming back to that one, the LBMA data, Beyond the Smoke and Mirrors. That was that mm-hmm. 2013 paper. And they said that there was 280 million ounces of gold trading every day, every trading day.
Wow.
In London. And I mean, it's you're looking at over 850 times the daily gold production there.
That's ridiculous.
So the it's an absurd level of trading that is it's divorced from that kind of it's almost a pedantic argument that that's really has to be delivered in the future, so don't worry about that. But the level, the gross, and it really is in both meanings of the word, a gross volume that's being traded there. 280 million ounces. I checked the most recent statistics on the LBMA, and for the month of May of 2014, on a gross daily trading volume level, it's about 190 million ounces of gold and 1.36 billion ounces of silver every day that's cycling on that exchange.
Yeah.
And the only way that we can explain that is that we think about this unallocated or in reality non-existent metal is cycling through these exchanges. Just as a point of reference, the level of gold trading is about 600 times daily mine production each trading day, and it's about 420 times the daily silver mining production rate each trading day in London. So it's Go ahead, Jim.
is just totally is just totally detached from reality. These markets, they have nothing to do with almost nothing to do with the underlying commodity.
They're creating their own reality. It's almost like a virtual reality trading system.
Mm-hmm.
And we talked last week about the concept of being technically focused and following these charts and looking for breakout levels. But I mean, you're burrowing into a matrix of data, which is really a construct of these digital trading systems, and it's not reflective of the market supply and demand fundamentals. And this matrix fails when the physical market asserts itself, as I think we're starting to see now in the platinum group metals sector.
Well, as my friend Jeff Deist, Ron Paul's chief of staff, likes to say, that perception is reality. In politics, I would say perception is reality in the equity markets and the gold markets as well. If we watch the gold markets, all of a sudden a massive smackdown with these major traders coming in, and that just has to happen at the right time to keep people disinterested in gold. And the only reason they're able to do that, I believe, David, is because of this massive detachment from reality, this ability to create money out of thin air, essentially, or contracts out of thin air, and slam the market by just a handful of traders, I guess, a handful of bullion banks. Yeah. So it really is a very serious issue that almost nobody, other than yourself and a few people like Larry Parks and people who are paying attention to the gold antitrust action guys, but almost nobody in the mainstream pays any attention, and even some of our friends sort of on the edge of the free market groups don't want to go there either. It seems it's just I don't know. To me, it's so basic and so fundamental. And of course, what I think, David, is there's growing opposition geopolitically to what's going on. The dollar being used as a legalized means of theft. Well, it's legal in America, but maybe China and Russia and some other places are saying enough already. So is this what's going on, you think, with the Shanghai Exchange? These guys are setting up their own exchanges, not only in metals but also in oil. Do you think we're seeing some major resistance from some of these other countries, and that may be what triggers an end to it? This abuse?
Yeah, it's the geopolitical angle. I mean, it may be even more simple than that. In that, China, which invented, paper money. In the 7th century, I mean, they had half a dozen paper money failures before they went on to the silver money system in the 1500s, roughly, rough time frame. But I mean, they actually need the metal, and what they're trying to do here, and I mean, on the state news agency, they advise people to buy physical gold and silver. Mm-hmm. And I mean, and we know that there's been $15 trillion of private sector lending in the last 5 years in China. And I think the Chinese, as well as anybody, knows where this ends, and it ends in paper money failure. Mm-hmm. And what they are doing is that they actually need the metal, because they think, strategically thinking, they're distributing this metal on a wide basis to the citizenry to help stabilize things. Mm-hmm. It's in the interests of China. And on the palladium and platinum side, I mean, they actually need the metal. They need that palladium for their catalytic converters. They've got a serious pollution problem. And so, what's happening here is that the Chinese need for the actual material is advertising the failure and really the Achilles heels or the deceptiveness of our derivatives-based digital market system.
Right. Well, it certainly seems to be a growing recognition around the world, not only in China and Russia and some of those countries, that they're of the abuses of what I like to call the Anglo-American Empire, and certainly seems to be a certain amount of blowback that's coming our way right now, towards the United States, for a lot of these things that are going on. But you pointed out to me there's a group that's, I think his name is Lars German fellow. His first name is Lars. He's involved with setting up really a rally, a major rally in 128 different cities and people from 5 countries in Germany protesting the Fed. Talk to us a little bit about that. What's your understanding about that? That event is supposed to take place on the 19th of July.
Yeah, there was Luke Rukowski of We Are Change. There was a video posted on the web of this, and just search "End the Fed" and you should be able to find it. But there's a July 19th protest of this End the Fed group, and it, I guess a couple of things. Yeah, 128 cities in 5 countries, but it's interesting that it's an End the Fed rally. Now, that might be outrage at the Fed that they're not returning Germany's gold. But they do talk also about the problems of fiat money, so maybe it's just a catchy term they're using. But but I mean, the issue is central banking and in the end, central planning and creating money from nothing. I mean, that's the central issue. Well, I guess for the Germans, it's also getting their gold back, and they've seen a paltry 5 ounces of the I think it was 300 tons that they requested, or
right.
8. So it's I mean, there's 2 issues there for the Germans. And of course, they're being portrayed as being anti-Semites for asking for their gold back and protesting the Fed, but it has nothing to do with that.
I don't get that connection at all. What's the alleged connection?
Well, the alleged connection is we're not talking about it.
Oh,
right. That's the bottom line. Is that we'll call you something so
yeah,
we stop
right.
shame you into submission.
Right.
Right. But we're not talking about.
Well, because I guess the connection with World War II, so they just go back and throw that in their face all the time.
Well, just give them their gold, and then they have nothing to complain about.
Right. No, that's exactly right. But it just keeps coming back at us, the whole issue of dishonesty. And of course, I've always believed, dating way back to when I had a history professor named Dr. Peyton Yoder, who was convinced there was a breakdown in the work ethic and in general in morality when you have dishonest money. And I think he's right. It seems to me that we've seen a huge breakdown in the moral, the ethical behavior of Wall Street and people in general, because they want something for nothing, David. And if we're offered something for nothing, it's pretty hard to pass it up, isn't it?
Yeah, the same problem occurred in Weimar Germany in the 1920s. There was a basic social order breakdown. And really with elastic money in the go-go decade in the Roaring '20s, we saw vestiges of that as well in the United States. But it's uncontrolled growth and creation of assets from nothing, and the virtual economies and the virtual wealth it creates does seem to disconnect people from, let's call it, sustainable long-term policy.
Right, exactly. Well, it seems to me that the Chinese are printing huge amounts of money. The citizens are taking that money and going out and exchanging it for real money, for asset-based money as opposed to liability money, whereas the Americans, for the most part, most Americans, except people that listen to this show and shows like it, are buying what? Stocks? Or they're buying whatever, I don't know. And maybe some of it is good, real estate if it's depressed and so on and so forth. But it seems to me taking that worthless paper money and buying something of value for it is the way to go, and of course keeping out of debt. But let's just sum up here a little bit, David. I think what you're saying here, then, going back to this GOFO situation and the platinum and palladium tightness in the markets, I guess what I'd like to ask you is help me understand a little better the connection between what's happening in the platinum and palladium markets. Why would that necessarily spill over ultimately to the gold market? First, I understand that those markets, platinum and palladium, are very thin, and the government doesn't have any supply of the metals, and same basically with silver. Governments don't have supply that they can use to or banks don't have supply to any great extent they can use to trash the market, to play this paper game longer. But why would one of those relate to the others? Why would platinum and palladium and silver ultimately the same problems lead into the gold market?
Well, okay, you can subdue interest in precious metals by trading derivatives, and so as long as you can keep the vast majority of people looking at the price and saying, well, that's the price of gold, it's not going anywhere.
Yeah.
And I've had people say to me, well, I am able to go out and buy gold, so there can't be a problem.
Yeah.
But so as long as you can contain 99% of the interest with the digital trading and make sure that there's enough physical there to meet the demand on the physical side, things are okay.
Mm-hmm.
And you can do that with the metals of which there are large official sector holdings like gold.
Mm-hmm.
Platinum and palladium, and historically we can see as well, looking back, is that the platinum and palladium have run before silver, and that silver has, and all three of those, platinum, palladium, and silver, have run before gold when there's been price spikes.
Mm-hmm.
So and I think that relates back to official sector holdings and intervention, which has really been, the intervention side has been fine-tuned in the last decade and a half by using derivatives.
Mm-hmm.
But we are still seeing these chart patterns starting to set up, and we have seen the price breaking out in China, by over $100. I mean, palladium is over $1,000 an ounce to purchase in Shanghai right now.
Mm-hmm.
So it's basically the fact that those are real market supply-demand fundamentals that you're seeing priced in there. Mm-hmm. And they're not really they're not the same as the gold price, which is a derivatives price with a physical feed on the side to contain interest to create the appearance of availability of the metal. We know that gold is less than 1% of the financial instruments out there.
Mm-hmm. So I guess if I'm hearing you properly, what we're looking at, the commonality is essentially is a shortage of all these metals relative to demand. The only thing is they want to avoid the tipping point, and it's easier to do with gold because there's enough physical supply to keep it looking like it's an honest market. Yes. And so you don't have these huge premiums in the short term on the backwardation that you have with platinum and palladium, and to a lesser extent with silver. But ultimately, when demand continues to build and people lose confidence in the paper, it is, after all, a big con game. That's what the whole thing is about, is conning people into wanting to have paper money as opposed to the real thing. And Greenspan said that in his article in 1966, Gold and Economic Freedom. The reason you have to keep people conned is otherwise the welfare state, the socialist state, the military industrial complex doesn't get fed, and that's what the establishment dies for, I guess, essentially. So anyway,
paper money is really an opiate. Mm-hmm. And what's happening is that the markets are drugged, and they are not able to truly measure what is going on. And that's why you get these tremendous distortions built into the market, is because of the imbalances that are created while the markets are being drugged down by the liquidity from the central banks.
Well put, David. I think that really summarizes it very well. I guess the issue is we don't know when the markets are going to crack, but and reading an article from David Stockman today, not necessarily talking about the gold markets, but the general markets, he wrote an article entitled "The Implosion is Near, Signs of the Bubble's Last Days." So I think David makes some very good arguments, and he's going to be on this show in a couple of weeks from now. We'll ask him about this article, and but certainly not unrelated, David. I'm sure you would agree with the precious metals markets as well, because if there is a loss of confidence in the con game, in the economic environment, and the markets break down, indeed as they did in 2008, 2009, we did see a move towards gold, and the real price of gold rise very dramatically, and with that, mining company profits went up very dramatically. So do you think we're pretty close to some sort of a breakout?
Yeah, well, I mean, the physical situation with the PGM metals seems to indicate that market is in trouble, and I would expect that to spill over to silver and ultimately into gold. But it's really I don't see it so much as a loss of confidence as a realization of the con. And that's the issue here, is that the markets are unable to function properly, that we're unable to have proper adjustment. And as a result of that, we've got hundreds of trillions of dollars of debt created in the world, which is unsupportable.
Right.
That's the real issue. They shut down reality by shutting down the gold markets.
Right.
And it's the paper market now that's going to ultimately it's going to fail. And the question is just how far they run it off the cliff before it actually starts heading south.
Right. Well, that's really true, and I think it's inevitable. The breakdown is inevitable, as we talk about on the show every week. The main thing and the main hope that I have is that when things do break down, the proper analysis of the situation is what we get, and not some sort of a phony excuse that it was some ethnic group or ideological group or something like that, a religious group that's caused the problem, but in fact they keep their eye on the ball. So David, you help us do that. We get Ron Paul on this show sometime in the near future. We have lots of people like you and good Austrian free market thinkers that I think are really adding very valuably to this show and to the understanding of Americans, so that we do reach the right conclusion when that day of reckoning comes. Thank you very much, David, for being with us again, and look forward to doing it next week again.
Thank you, Jay.